Now let's take another example for how exactly an investor can use index futures in order to lock in a certain profit. So it may so happen that a certain investor may be very confident about their stock selection, and that way they may want to take a certain position in futures contract which will help them lock in a certain profit going ahead. So let's understand this through a simple example. So we'll look at a certain investor who is holding an equity position who believes that the portfolio which they are holding is uh, going to perform better as compared to the broader market, and they would like to lock in that profit. So let's understand this through a simple example. So let's say that a certain investor holds 20,000 shares of a company, and let's say the current market price for these shares is $100 per share. And let's say the stock beta for this share is 1.1. Now, the investor is expecting that there is going to be a significant amount of volatility in the market in the next few months. But again, he believes that the stock which he has picked up has a potential to outperform the market. Now, let's say today we are standing on the month of May. Now, as per this strategy, what an investor can do is they can take a short position in, let's say, the August futures contract. And let's say this is the information on the August futures which is currently at hand. So August futures contract is at 2100, and each contract is for a delivery of 50 times the index. So this is the standard multiple which has been prescribed by the index. So let's understand the scenarios, and let's focus on the workings which depict the way in which the profit can get locked in if the investor is confident and if the market moves accordingly. So let's calculate VA. This is the value of our current portfolio, which is 20,000 shares into $100 per share, which gives us 2 billion. Then we have VF. So it's 2100, which is the current price for August futures into the standard multiple of 50 as prescribed by the exchange. This is 105,000. Now, the optimal number of contracts to be shorted here will be beta, which is 1.1, our current beta, into 2 million upon 105,000, which gives 21. So the actual result is 20.95, but we'll just round it off to 21. So as a part of this strategy, the investor is going to go short 21 contracts. Now let's take two scenarios to see how exactly a profit gets locked in through the usage of futures. Now let's take scenario one, whereby the company's stock falls to 90 and the futures price falls to 1850. Now, because the stock has fallen from 100 to 90, there will be a loss on the stock position. So the loss is 100 minus 90 into 20,000 shares, which is minus 200,000. However, because there is a drop in the stock price and also the corresponding the futures price also have dropped, there is a benefit or profit which is earned on the short futures position, and that is 2100, which was the original price of the August futures, minus 1850 into 21, which is the number of contracts which are to be shorted, into 50, the standard multiple, which gives a positive 262,500. So at a net portfolio level, the profit generated is the difference between these two quantities, 262,500 minus 200,000, which gives a profit to the investor of 62,500. So this profit gets locked in. Now let's take another scenario whereby the stock price rises. So we are earlier at 100, and let's say the price goes to 110 and the futures price rises to 2,200. So because the stock price has risen, the investor is going to make a profit on the stock position, which is 110, the current market price minus the original price of 100 into the number of shares, which is 20,000. So we get a profit of 200,000. Now the futures position is going to lose because the futures price has risen, and that loss is 2100 minus 2200 into 21, which is the number of contracts, into the standard multiple of 50, which gives us minus 105,000. Again, at a net portfolio level, we are going to add these two, that is 200,000 minus 105,000, which gives us a value of $95,000, which is the net profit on this position. So this is how an investor might want to use stock index futures in order to lock in the benefit from their stock selection.